Good morning. I'm Jeff Boundy, President of Cornerstone National Bank and Trust Company. And on behalf of my colleagues at Cornerstone, thank you for joining us at this is our 10th annual economic breakfast. Fortunately, we go back with Dr. Genetski quite a bit before that. We've been doing presentations with him through the prior bank group since 1981. And many of you have seen him certainly more than 10 years, but thank you again for joining us. Before I begin, I want to have a sincere thank you. Several colleagues of ours, Linda DeBerge, Lynn Marvin, Wendy McCarthy, and John DeLappa for their efforts in coordinating today's events. I would also like to thank Bill Latner over here for coordinating today's videography. As this presentation will be up on our website in a couple weeks for those who want to see it or if they want to share it with anybody else. And as you can see, we're hoping the new monitors we've added in the room. Thank you. That you can see in the back, and it's not important for you to see me, but I know that the facial expressions and the charts that Dr. Genetski puts up there, a lot of you miss. I want to take a minute and update you on what's happening at Cornerstone. Yesterday was Cornerstone's 13th anniversary. So, since the majority of you are, well, thank you. As one of my clients said to me, he said, you know, your company anniversary is important to whom? I said, well, no, everybody, right? He said, no, just you. But that's pretty profound. Well, since the majority of your clients and shareholders, I just want to take a minute and give you a brief update on how your bank is performing. We're proud to report that Cornerstone continues to remain strong and well capitalized. And in fact, our capital position continues to improve every year. Our wealth management team has had great success for the past year, not just because of the market, but this time last year there were just over $500 million in assets under management, and today I believe there's $611 million in assets under management today. Overall, the bank, we manage over $1 billion in assets, so we're pretty happy with that. Our mortgage team continues to do great. They've had a lot of success. Certainly the low interest rate market has had a positive impact on that, but our mortgage volume for those of you who've been able to refinance, that's been an important component. And really, very importantly to us as well is the quality of our loan portfolio. The quality has been a key component. We've put that at the forefront through all the economic challenges we've seen. And we're happy and very pleased to report that the quality of the portfolio, the trend has continued very positive, and we feel that we've got a lot of the challenges and concerns more so in the past. You know, so why do clients choose Cornerstone? I like to believe it's because we stand out from our competition. This is the chance where I get to advertise. A few Cornerstone facts. Some of you know this, but Cornerstone is primarily owned by its employees and directors who come to work there every day. So over half of the ownership of the bank comes to work there every day. And I might add, voluntarily. Not about coming to work, but they're voluntarily as shareholders. It's not a requirement to work at Cornerstone to be a shareholder. Our turnover. Our annual staff turnover is less than 5%. Many times I've had customers come up and say, you know, it's frustrating when you go and you have to re-educate a banker on your business. And when you see our turnover is very low, there's not a lot of re-education that's happening. We've got a lot of history with our client base, so that's been very helpful. Caliber of staff per client. We have a higher level caliber of staff per client than our competition. And what I mean by that, I'll give you one example. Including myself, there are 7 staff members on Cornerstone that either are or were a former bank president. Not too many community banks would say that. And so the level of experience that we're exposed to is much greater. And then finally, you know, we really like to be value-added. We like to figure out a way to help our clients. You know, if we just become bankers every day, it can become quite boring. But if you treat it as something you enjoy to do, and you look for value-added opportunities, it makes a big difference. Now I want to give you an example. One of our clients, who's a marketing company, approached the bank recently with a problem. He said one of his largest clients was a publicly traded company that, when you looked at the public numbers, the company was doing quite poorly. That company fired their CFO, and the new CFO came in and said, hey, we're no longer going to prepay you for your marketing activity. So our client had about a 30% margin in this company, and at times would carry $2 million worth of business with them. So to carry a $2 million receivable to a company that's not performing well, even though you have a very good margin, is scary. And the owner came to us and said, I don't really want to risk $2 million of my own money. I know at the end of the year I probably make $700 grand off this company a year, but if they go under, I get nothing. And he said, so I just want to get your advice, but I think I'm going to stop doing business with them. And we said, no, that doesn't make sense. How about we introduce you? So we brought in a AAA rated insurance company, multi-billion-dollar company that insures their receivables. And for $25,000, he insured all those receivables. So to make $750 grand on a company, when you're spending 25 grand for insurance for 100% of that receivable, was pretty good. That's what's fun. That's the value add. And that, in my mind, with that client, with the relationship team that he has on it, really made a client for life. And so that's been a lot of fun, and that's what makes it a benefit being a Cornerstone. Well, as most of you know, our bank has grown as a result of referrals, and it's, quite frankly, we don't advertise. It's really people like you that have helped us grow. And on behalf of my colleagues, we thank you for your continued belief in our team and your bank. Well, the timing of this economic breakfast this year is interesting once again. Last year, we were talking about the presidential debate, the election coming up. This year with the government shutdown, we certainly have many other activities going on in government to talk about as well. It almost makes me a little afraid of what to think next year is going to bring up. I'd like to close by saying thank you for taking your time today out of your busy schedule to join us with the economic breakfast. And I'd also like to thank our clients, partners, shareholders, and directors for their trust and continued belief in Cornerstone. Following the presentation with Dr. Genetski, he will be taking questions. We'll have two individuals on each side of the room that will come around with a microphone to answer any questions that you have. Give you some background. I know many of you are fortunate to know Dr. Genetski. You've met him, you've seen him speak. For some of you who haven't, I'll give you some background. Dr. Genetski was named one of the top 5 forecasters in economics and finance. He's one of the nation's premier interest rate forecasters and investment advisors. He provides insights to economic, financial, and investment matters as the head of his own consulting firm and at his website, classicalprinciples.com. On 2 occasions, he was recognized as the #1 interest rate forecaster in the country. He's taught economics at the University of Chicago's Graduate School of Business and New York University. He's a former senior vice president and chief economist of a major Midwest bank. During the course of his career, he headed asset management, investment research, and investment banking operations in Chicago. He's also served on the board of directors of several public companies. I'm going to keep going. He's a leading proponent of classical economic principles, and he's written a number of books, including one we had here a couple years ago, the Classical Economic Principles and the Wealth of Nations. He earned his PhD in economics from New York University. And fortunately for us, not only does he have a way of explaining economics in an informative approach we can all understand, but we also enjoy it because he does it with a sense of humor. So please join me in welcoming Dr. Robert Genetski.
Thank you, Jeff. I just want to make sure that the introduction doesn't go longer than the presentation. I'd like to begin because Tom McCarthy always likes me to go back and review what I said a year ago to try and put some things in perspective, whether I got things right or whether I got things wrong, how the year went. And since Tom and Jeff hired me, I found it's a good idea to always do what the people who hire you suggest should be done. A year ago, let's just set the scene for what was happening. It was several weeks before the presidential election was to occur. And we had these kind of things going on. Government spending was rising very rapidly. The debt was increasing out of control. The Republicans and Democrats were fighting over something called the fiscal cliff that threatened to shut down the government at the end of the year. Well, thank goodness those days are gone. And in light of that climate and all that uncertainty, I ended up with a number of projections. And one projection I made was that I didn't believe President Obama would be reelected. And so in keeping a scorecard for last year, that certainly is one thing that didn't go very well. I did say, however, since I didn't know for sure how the election was going to go, that if the president was reelected, and I took this as a direct quote, we would continue to have sluggish economic performance and life would go on. Now, he was reelected, we had sluggish economic performance, and the fact that we're all here today suggests that life did go on. So I'm going to give myself credit for getting that particular one. I also suggested that regardless of who was elected, I thought that we would finally see a pickup in the pace of spending in the economy sometime in the spring or summer. And we did not. Basically, the figures that we have show that the overall economy spending has remained increasing at a rate of maybe 3 to 5% in that range for the past several years. So that didn't work out too well. In terms of financial markets, I did say that interest rates in the short-term area were likely to stay very low, right where they were about a year ago. But that in the long-term area, we were likely to see a 1 percentage point increase. So the Treasury bond rate, 10-year bond rate, going from 1.5% to about 2.5%. It's currently about 2.6%. So that ended up being a pretty good forecast. Now, the stock market, I did say that if President Obama were reelected, I expected that we would see sharp increases in tax rates, government spending, and as a result of that, the stock market was likely to go down. Well, now I'm an easy grader, but I gave myself a D for that particular performance. However, not being satisfied with a D, fortunately, a number of you get my weekly reports, my monthly reports. So you can see that as conditions change, I also change my forecast. And there was a big change in conditions. Right at the beginning of the year, the president sent Joe Biden, the vice president, to help negotiate an agreement regarding the fiscal cliff that was about to occur. And the vice president actually did a pretty good job. What they did is, in the compromise, they took off most of the most destructive tax increases that would have gone into effect. There were some increases that went into effect, but the most destructive ones were eliminated, and they made the tax rates permanent as anything can be with the government. But what that meant is it is not going to be a huge pressure to fight against tax increases in the future, and that meant that the Republicans who were trying to limit spending would have a little more power to get that done. And so, right at the beginning of January, as soon as that agreement was made, I quickly shifted my assessment of the stock market. I said you should be fully invested in equities, in the equity portion of your portfolio. And the market's up about 20% since that time. So, since I give myself grades, I revised my grades to a B+, which is at least in the vicinity of being acceptable. So, as you know, given the political dramatics of the past couple of days, past couple of weeks, we live in a terribly confusing time, a time when policy changes can change abruptly for better or for worse in a dramatic condition. I think this is part of the characteristics of living through such a unique period of history. I've claimed before, and I continue to claim, that we are so fortunate because we do live at one of the most unique, what I think is the most unique, the most exciting, the most dynamic period in all of history. And periods of dynamic change can certainly be challenging, but they can also result in some very wonderful developments. One thing I like to point out is that in the past 2 decades, there are data from around the world that suggest that half of the world's population that lived in abject poverty 2 decades ago has been risen from that terrible condition. That's a billion and a half people. A wonderful development. We also live at a time when we have information at our fingertips that people throughout history could only have dreamed of having. And of course, when you have information, you also have a tendency to have misinformation. I'm told that there are some people who get their entire knowledge of what's going on in the world from Jay Leno's monologue. And some of these people appeared to be very concerned when Jay told them that hackers had broken into the U.S. Treasury website and made off with $16 trillion of our debt. Unfortunately, we still have the debt. So that hasn't occurred. Well, as I've done in the past, my objective this morning is to try and make some sense of current economic and financial developments. Try and make some sense about what's going on. Clear up as much of the confusion as possible. And also provide you with a framework for analyzing economic developments that are occurring and trying to take the most significant parts of that development and suggest or find out what that means for your business and your investment. By way of organization, there's a lot of ground that I want to cover, and sometimes I'll cover it very quickly. So if you have any questions, I'd like to be able to get to that. But I'm going to start by way of organization with that framework. I always like to use that as a base because the framework is how I go about trying to talk about the key issues that are going on. The key issues, as I see it, Illinois, the U.S. economic weakness, Illinois' weakness, the financial crisis that occurred not so long ago, Fed policy, federal debt, government shutdown, and the outlook for the economy and financial markets, and then quickly the takeaway points. But let me start with the economic framework. By framework, I mean the explanation that economists have of why some economies do very well and perform well and people prosper, and why sometimes economies don't perform so well and people end up suffering. And the problem here is that there are 2 basic frameworks that economists use. And they are opposed to each other, they have different assumptions, different conclusions. The 2 frameworks are called the Keynesian framework and the classical framework. And the Keynesian framework basically has the assumption that the reason we have poor economic performance, which they define as booms and busts, is because we have very erratic spending on the part of private individuals. Individuals, businesses have a tendency, according to the Keynesian, to either spend too much money and create an economic boom or not spend enough of their money. And they get too depressed and we have an economic bust. And because of this explanation for why we have either great times or poor times, the conclusion is that the government has to come in and correct all the problems that the private sector has in terms of stabilizing spending. So if we have a boom, the government comes in and should raise people's taxes so they don't spend as much money. Or if we have a bust, the government can come in and spend more money to lift up the economy. That's the Keynesian explanation. The classical explanation is pretty much the opposite. The classical explanation, to which I subscribe, says that on balance, the private sector has strong incentives to make the right decisions. And under the right environment, we will have a pretty smooth operation of things. And there are very powerful forces that kind of ensure that. Basically, people want to work to support themselves and their families so they can buy the things they need. And companies want to hire those people to produce the things that people make. And so left to its own, you've got some very powerful force at work here. And there's a normal tendency for this to happen and for economies to grow over time. And the only time we have either a boom or a bust in the economy is because the government has come in and made a policy mistake and put up barriers to that natural occurrence in the economy. But even here, there's some hope. Because when government makes a mistake, we can see that government obviously wants to correct that mistake, right? For example, President Obama was told recently that the IRS had been targeting conservative taxpayers. And the president said this was outrageous, and then he would immediately have his Benghazi investigators look into this thing. Well, maybe sometime government doesn't correct things as quickly as they otherwise would. As classical economists, I believe that there is a basic flaw in the Keynesian analysis. The basic flaw is that as a community, we cannot spend any more in real terms than what we have produced. And when we add up all of our production and all of our income, it all comes to exactly the same. And so we're going to spend in real terms exactly what we produced in each time period. No more, no less. And so there will be a great deal of stability. Now, as individuals, we can always spend more or less. We can spend more when we borrow, say, buy a house. But borrowing mainly means taking the income someone else has earned, producing goods and services in the current period, and using it for ourselves to pay for the house. And in return, we're going to promise to take some of our future income and give it back to those people. That's what a mortgage is all about. But the main conclusion of classical economics is that government doesn't stimulate the economy. It certainly doesn't stimulate spending. Because government has only two ways of spending money. One, it taxes the income away from people, in which case they can't spend it. Or two, it sells someone a bond, a government bond, so they can borrow the money to spend the money, in which case the people who bought the bond don't have the money to spend. So you cannot spend the same money twice. It's a basic flaw in the analysis. Now, economics shouldn't be this complicated. And it isn't. Classical economists, over 2 centuries ago, said that in essence, economics is very simple. All you have to do is get people to combine resources right in the most efficient way possible to produce things that other people want. And people will do that if they have the right environment. The right environment, according to classical economists, consists of making sure people have low tax rates, limited government, there are free markets so that people can, so that what's produced or what people want to be produced, sort of goods and services they value the most. And if you have free markets, you have the most efficient combination of resources. And you have to protect people's property rights. You have to have a stable currency so you don't cheat people with inflation or drive people out of business with deflation. Basically, if you look at these classical principles, they all involve one thing: a respect for the individual, a respect for the decisions that people make, giving individuals more power, more control over their lives, more economic freedom. And I mentioned last year that when God created us, He decided to give us free will. And it's my belief that in giving us free will, He also gave us the key to economic prosperity. Because when I look back at history, and recorded history begins somewhere around 4000 BC in ancient Egypt, and you look at it right up through the medieval period, it was a period when people did not have economic freedom. Basically, they were controlled by the king, the lord, the emperor, the church, but there was some authority that basically dictated how you lived your life. And there were a lot of inventions over this period of time. But if we look at living standards in the medieval period, They were no different from what they were in ancient Egypt. No significant difference. Then in the 16th, 17th century, you started to see people have more freedom over their lives. With the discovery of America, people were able to move to America where they had greater freedom. And after the American Revolution, when we had our Constitution, we had the first Constitution in the world based on giving people a maximum amount of freedom and choice over their life. It was their responsibility. And what happened in the next century? People flooded from all over the world to come into this country to take advantage of the first country where they had complete economic freedom over their lives. And within a century, the U.S. became the most powerful country in the world. Economic freedom is equally as important today. I mentioned last year that the Fraser Institute out of Canada measures economic freedom in every country of the world. And what they found is that the countries with the highest degree of economic freedom also have the highest living standards. And it drops off pretty rapidly as you go down with countries that have less economic freedom. What do I mean by economic freedom? Following the rule of law, giving individuals more control over their lives, not having government policies that reward one group of people at the expense of another. If you're concerned about the poor, what the Fraser Institute finds is that the poor do significantly better economically in countries with high economic freedom and high living standards, significantly better than in other countries. So the bottom line of the framework is that economic freedom, classical economic principles, are the key to economic prosperity. Whenever you see policies moving in this direction, whether it's in a country or whether it's in a region or a state, you will tend to find much better economic performance. And whenever you move principles away from these classical principles of economic freedom, you'll tend to find poor economic performance. That's the framework. Now, let's begin by looking at the economic weakness in the U.S. economy that's developed. And it's no secret that our economy has gotten weak. A lot of people are wondering why it's as weak as it is. If we look at the Fraser Institute measure of economic freedom, what you'll see is that we've gone in the past decade from one of the freest economies that you can ever imagine, a very high score in economic freedom, down to a much lower score. And if you compare the U.S. to other countries, we were often in the top 3, usually behind Hong Kong and Singapore, but certainly the only major country in the world with a high level of economic freedom. As of 2011, we ended up being 19th in the world, the 18th country where there is more economic freedom than in the United States. Why? For a number of reasons. One, we have a lot of programs through Congress where we reward one group, one business, at the expense of other businesses. There's favoritism, there's lobbying, like crazy. We have violated the rule of law progressively more in recent years than we had before by issuing edicts instead of going through the Constitution and the normal legal process. And we also have huge increases in government spending. Now, we've had them over the past decade. You might have heard that government spending is actually flattened out and may even be going down. That's not really true. We have to understand that most businesses use generally accepting accounting principles known as GAAP in order to do their books. Instead, our government uses something that I like to call PAP, politically acceptable accounting principles, in order to do their books. And so there are a lot of things that are in the federal budget that are not done according to normal accounting principles. For example, a lot of the weakness in the federal government spending has been because we've seen money repaid that was loaned out several years ago. Well, instead of counting that as money coming in, revenue, the government counts that as negative spending. And that's a very temporary thing. So spending will actually, and is on a very strong road of increasing even now. There are also regulatory compliance expenditures that I estimate come to about $2.2 trillion a year during the current period. That's money that's spent in the private sector because government regulators have told them to spend it. It's money that individuals cannot use to spend for the things that they think are very important. What is the effect of this abandonment of economic freedom, classical principles, or at least the erosion of it? Well, if you look at hours worked, what we find is that they've been fairly depressed in our economy for the past decade. We've had a recent upsurge in hours worked, but for most of the past decade, they've been going down. I think they're going down for two reasons. One, when the government puts all these regulatory burdens on businesses, businesses get rid of their most expensive cost. The most expensive cost tends to be the worker. And so that's been one reason. Another reason is there have been recent studies that have shown that we're very generous to people who don't work. There are actually 8 states where it's calculated people can make more on welfare than the median wage. Median wage means that there's many people making above as making below it. And there are 35 states that you can get more on welfare than you can from the minimum wage. So we've made it very attractive for people not to work. Even more important than the fact that there's less work in the economy. One last thing, it appears that we've now seen businesses cut as many people as they can reasonably cut to boost their productivity. So we're seeing hours worked go up. But if we look at productivity, it's not doing very well. Now, what do I mean by productivity? Productivity is the efficiency with which we put together the resources. Productivity is what determines our living standards. And productivity historically has increased a little over 2% a year. What that means is that every 32 years, our living standards have doubled in this country. That's our history. What that means is that for working the same 40-hour week that you worked 32 years ago, you would have twice as many goods and services available to you. That's the nature of what was our country. What it is now is productivity growth has slowed, and it appears, if you just take the past few years as a new trend, it's now about 0.7% a year. What that implies is if that were to continue, not getting any better or any worse, it will take 100 years to double living standards instead of the 32. That's the deterioration that has hit this economy because of the erosion in economic freedom that's occurred. Let's look at Illinois' weakness very quickly. Interestingly enough, Illinois is really an abnormal state from an economic standpoint. And it's abnormal not because of all the reasons you're probably thinking about, but it's abnormal because in most states, if your tax burdens are below the national average of other states, your state and local tax burdens, and if they're declining, you tend to have above average economic performance. For most of the past 20 years, this is the national average. Illinois' tax burden has been 10% or more below the national average. You may have recognized that there was a tax increase recently here in Illinois, and Illinois' tax burden is no longer below the national average. It's now close to, as of last year, about 10% above the national average. Why I say Illinois is abnormal is because this is Illinois' share of the nation's personal income, which has steadily gone down over the course of the past 20 years, in spite of a low tax burden. With the increase in tax burden, there will be even greater pressures to reduce growth in the Illinois economy. If we look at housing prices in Chicago, which is the only place that they're available where you can compare them to the rest of the nation, what you can see is the effect of slower growth and what it has on housing prices. The housing prices here have not done as well as the rest of the nation, although they are coming back. Another problem Illinois has is the debt. there is an Institute for Truth in Accounting, where accountants go through state budgets and the federal budget and try and place those budgets on generally accepted accounting principles instead of patent. And what we find is that when you do that, Illinois is actually the fourth worst state in the nation in terms of committing future taxpayers' income to current programs. On a per capita basis, per worker basis, Illinois has committed about $24,000 per worker to future expenses that they have not accounted for. So Illinois is not in a good position here. I want to turn now to the financial crisis that occurred a couple of years ago. And basically, a lot of people believe incorrectly that what the Federal Reserve does is it prints money. And hence, they put money in the economy, and all of a sudden that money is available, much as a counterfeit. Well, the Fed does have the power to create money out of thin air. Technically, they don't really print the money. What they do is they buy securities, usually government securities, pay for it with a check. The check gets deposited in a bank. The bank takes the check to the Fed. And the Fed then credits the bank with the deposit, something we call bank reserves. Bank reserves are the first step in the monetary process. And if the system is working as it normally does, the bank then loans and invests that money out. It goes through the banking system and ends up creating an increase in money and spending. But the funds have to go through the banking system in order to do that. In the past decade, let's look at what happened to these bank reserves. Coming out of the last recession, they increased 5% a year through the middle of the decade. That's a lot. And it led to a 6 to 7% increase in spending. This was the boom that we experienced, the housing boom and everything else. Why did we experience the boom? Because the private sector all of a sudden felt wealthy and went out and spent money? No, it's because the Federal Reserve was putting these extra bank reserves into the system. And banks were loaning and investing and levering them. And so we had the economic boom. And then what the Federal Reserve did, they discovered that they had put too much money in. The spending was too fast. They started to take bank reserves out. They didn't take a whole lot out, but when you have people making plans based on spending going up 5, 6, 7% a year, and all of a sudden there's raw ingredients for money that are actually going down, that creates tension in the system. And it creates the beginning of a downward spiral. Even so, I don't believe that's what caused the financial crisis. I believe this would have caused just a normal downturn. But in September of 2008, the government made a decision that had the effect of taking another $20 billion out of high-powered money. They didn't take it out of high-powered money directly. What they did is they made a decision to place Treasury as a senior creditor to Fannie and Freddie, the bankrupt government agencies. And that decision all of a sudden made the common stockholders of Fannie and Freddie worthless overnight, and made the preferred stockholders worthless overnight. $20 billion of that stock, preferred stock, was held by U.S. banks. As a result, with one decision, they took $20 billion out of bank capital. That was supporting $200 billion in loans and deposits. And since the economy was already weakening, prices were already falling, banks couldn't raise capital by selling stock. And so what they did is they basically started to call in loans. So whatever equity they had ended up being, or whatever capital they had, ended up being a higher percentage of their total assets. And that's what triggered the financial collapse. Within a week, Lehman Brothers failed. Within 2 weeks, the auto companies were failing, AIG was failing, bankruptcies were occurring all over, asset prices were collapsing. It was a mistake on the part of the government, a very foolish mistake, a mistake that's been very painful for an awful lot of people in getting through this. Let me turn now to Fed policy. What's happened since that collapse? Well, the Federal Reserve immediately in October, November of 2008 increased bank reserves by $1 trillion to try and help the situation. But since banks were in such bad shape, every dollar of reserves that was created, banks ended up keeping at the Federal Reserve. So we had very little increase in bank reserves. We had a bit in 2009, a bit more in 2010. In the past couple of years, the past 2 to 3 years, we've had an enormous increase in bank reserves that actually in the banking system. This is over and above what the banks are keeping with the Federal Reserve. And again, under normal conditions, banks would loan and invest these funds, and we would see a huge rise in spending. These are not normal times. Regulators are in banks telling them to raise capital, however much you have. It just doesn't seem to be enough for the regulators. And also, the regulators are in there telling the banks what their assets are worth, what their loans are worth, and what type of loans to make. And as a result of this, banks have not been expanding loans and deposits. They're up less than 2% over the course of the past year or so. And so as a result, what we're seeing is we're seeing all this money get clogged up in the banking system, and it's not coming out in the form of spending or inflation. Am I still on? Okay. Couldn't hear myself. At any rate, so what we have in Fed policy is a very confusing system whereby, with one hand in Washington, D.C., they're creating all these bank reserves. They're getting it in the system, into the banking system, to increase spending. But on the other hand, the Fed regulators are in the banks, reducing the incentive to loan and invest. I think the best graphic I can find for this offsetting policy is the old Dr. Doolittle push me, pull you character. So the Fed is working it at both ends. Now, the fascinating thing about this, it probably ended up with an ideal monetary policy. Our economy can't grow because of productivity and because of hours worked, because of what the federal government has done, any faster than maybe 1% to 1.5% a year. So we don't need 5, 6, 7% spending if you can only produce goods and services at a lower rate because of what the federal government has done. So we've had really what monetary policy has not been all that bad. It's been basically conflicting errors that have occurred, but they've had the right policy given the very poor government situation in terms of discouraging productivity and hours worked. We turn to the topic of the moment, federal debt and the government shutdown. To begin with, I like to compare the U.S. with other countries in the world, just to see where we stand. And you see, most of the European countries have relatively high rates of government spending relative to the U.S. Incidentally, we are now very close to Europe, and if you add our regulatory compliance expenditures, we're probably right there with the rest of Europe. Europe's economies do not perform well. They grow very slowly. And guess what? Now that we've adopted their policies of increasing our role of government spending and regulation, we're not growing very rapidly. It goes with the territory. But in a sense, it's even worse than that. If we look at our debt relative to Europe, officially, we're in third place in the world, or fourth place in the world. We're just below Greece, Japan, and Italy. However, remember GAAP versus PAP. The Institute for Truth in Accounting, when they go through the federal budget, they don't come up with a debt of 16 or 17 trillion. They say the debt, based on what we've promised from future taxpayers, is $74 billion, or more than 4.5 times a year's GDP. Much more difficult to handle than most people are arguing about in Washington over a mere $17 trillion debt. Basically, the U.S. is bankrupt. Now, having said that, immediately when you talk about bankruptcy, People think of Armageddon and total collapse of the economic system. That's not what bankruptcy all about. Bankruptcy is pretty simple. What you have done in the case of bankruptcy is you have promised more to people in spending than you can ever conceivably hope to come up with in terms of normal operating businesses. And so what do you have to do? What you have to do is you have to cut back on your spending. It's the only solution. A lot of people think one of the solutions might be to raise taxes. But if you raise taxes, you actually have slower growth, less wealth. And so your economic conditions get even worse. So that's not an option. So the options are major cuts in future obligations, major reductions in government spending. And that's what the current debate is about in Washington. Because the sooner these cuts are made, the less pain there's going to be in the future. The longer it goes, the greater the cuts are going to have to be. And people who are not planning on cuts in their retirement funds or in their medical expenses that the government is helping them with are going to end up being the ones who are hurt the most. So that's what the debate in Washington is all about. What about the outlook for the economy and financial markets? My outlook this year is not much different. I did so well last year, and the outlook is not that much different for this year. Basically, spending pace is 3 to 5% continuing, and roughly half of that in inflation, half of that in real growth of the economy. So we are going to move forward. We are going to grow, but again, it's going to be relatively sluggish growth. There's still going to be excess capacity in the economy. There's still going to be poor productivity. Living standards public are going to be going down. Why? Because the government continues to take a huge portion of the income, either directly in taxes or indirectly by borrowing or in regulatory compliance expenditure. Incidentally, at any point, if the regulators were to ease up on the regulations of the banks, would say, for example, okay, you've got enough capital, now you can make loans and expand. We're really satisfied with the job you're doing. This spending pace has the potential for going up very rapidly. But that's up to the regulators. And right up through the latest month, I see no evidence that there's anything happening in that area. So this is my range for now. But I'm watching very closely to see if anything's going to happen to change that. In terms of housing prices, new home prices right back up to the peaks that existed before the crash. Existing home prices, they were down as much as 34%. They're now down about 22% from their peak. And if you look at the futures market, the futures markets are saying that those prices are going to be up about 10% over the course of the next year. Inventories remain low. There's a pretty low level of inventory, so there aren't that many existing houses for sale relative to the demand. And also, The Economist magazine does an analysis that's usually pretty of whether or not housing prices are currently undervalued or overvalued. They hit the nail on the head in terms of saying they were overvalued. They now believe they're undervalued based on rental costs, income, interest rates, things like that. So housing prices going up. Auto sales have come back very, very strong. And it's my expectation that we're going to see some leveling off here because people have bought autos. Autos are great technologically, and they're likely to last quite a while. In terms of gold prices, there's a strong tendency for prices to revert to the rest of commodities, gold and oil and anything else over time. Several years ago, gold jumped out of that range and increased very rapidly. What that suggests is in the future, we could have significant downward pressure. How much? If gold were to just get back to where it was based on all other commodities, we'd be at $700 an ounce. What that suggests is to be very leery about buying things or investing in things or planning on things that are well above what I would call fundamental price. Same thing is true, but even more so for oil. Oil had the same pattern as gold, now about $100 a barrel. Based on all commodity prices, oil should be about $45 a barrel. And in oil, the case is even stronger, because oil has a competitor in the form of natural gas. And if we put natural gas and base it on an oil equivalent energy price, natural gas is now about $20 a barrel. So what this suggests is strong economic pressures over the next decade to bring the oil prices down and the gas prices back up. In terms of interest rates, the Fed has artificially held rates down. It cannot do this indefinitely. And the longer it keeps these interest rates artificially low, the greater the increase will be when the rates go up. We've already seen the beginning of an increase in the long-term area. I suspect that's going to continue over the course of the next year. Basically the same forecast I had a year ago. I think we'll see another percentage point increase in long-term rates over the next year. And by this time next year, I believe we're also likely to see the beginning of short-term rates have pressures to go up. In terms of the stock market, profits have been very good as the S&P 500 trend over the past 50 or 60 years, and very, very strong. The most impressive thing, and one of the reasons why I am still positive on stocks, is that the earnings yield on stocks is now between 5 and 6%, and it's more than you can earn on bonds. That's very unusual. It suggests a very high risk premium that people are associating with stocks. And so I think that they're discounting a great deal. Stocks are still undervalued. They're not, in my judgment. A couple of years ago, or a year or two ago, I was telling people in my publications I thought the market was 40% undervalued. I now believe it's closer to 10 to 20% undervalued, but still undervalued. There will be a time to get out of stocks when the interest rates really start to soar. And at that point, I believe the return to stocks will be below the return to bonds. I don't believe that time is just yet. So the takeaway points from this presentation, the debate in Washington is over some very major issues. Namely, the country is bankrupt in the sense that it won't be able to pay future obligations. And there are certain people who would like to see us deal with that problem sooner as opposed to pass off the pain and much greater pain in the future. There are other people who don't believe it's a problem at all. And that's what the debate is about in Washington. And that's why people feel so strongly on both sides of the issue. I do not believe we're going to have an economic collapse. I believe those powerful pressures I talked about will continue to move the economy up with people wanting to work and companies wanting to hire them. And unless the government makes some major mistake, such as they made in 2008, where they all of a sudden do something very foolish, I would never put that past the government, but I think the odds of that is something we just cannot count on. In terms of economic freedom, where areas are going to be growing and expanding, I would look to areas that are promoting economic freedom instead of those areas that are pulling back on it. So the best opportunities for growth are in those areas. In terms of the specific advice, I would continue to invest in stocks, but I would pay attention to my weekly and monthly newsletters because changes in policy could easily change that call. I would avoid bonds at all costs, long-term bonds. I believe they're tremendously risky because when the interest rate increases begin, they will be very rapid, as they were a couple of months this past year, and the value of those bonds will drop precipitously. Two pieces of advice that I like to give because I think they're extremely important, especially for anyone who runs a company. You already know that you're under a great deal of pressure in your companies, from regulations, from costs, from healthcare, from all of the factors that you're facing, in addition to the normal business factors. You need to increase your efficiency, and you know that. But when you look at your customers, they're under the same pressure. They also need to increase their efficiency. So anything you can do to help them would be much appreciated by them. And the following thing, and I can't stress this enough, it's helping your customers to economize on the most precious resource they have, which is their time. Anything you can do to save them time, well rewarded. Anything you do to waste their time is going to come back and hurt you. Let me quickly summarize by saying, yes, the U.S. is no longer a leading economy in the world in terms of either economic freedom or growth. Living standards are declining. There's something wrong, and most people know this. However, most people don't realize that we've had significant deterioration in our position in economic freedom, nor have they connected the dots between the loss of that freedom and the implications for economic performance. I believe they will. I believe Winston Churchill was absolutely right when he said you can always count on Americans to do the right thing after they've tried everything else. We're in the process now of trying everything else. We're asking government to do more and more, take over more and more responsibility. It won't work. It's never worked. We live in a very resilient, recuperative democracy. I believe that before long, people are going to realize that this is not the direction they want to go. It's too painful economically. Once they reach that conclusion, they will force a change that returns us to our roots, returns us to focusing on economic freedom. And when that happens, I believe we will once again be what we were created as a country to be, the preeminent example in the world of a country that gives its citizens the greatest freedom, opportunity, and prosperity of any country